Hey, what's up everybody? I'm gonna get straight to the point in this video. Today, we're talking about the 4 highest monthly paying dividend stocks, and I'm gonna talk about some pros and cons. We see these videos here. These are some really popular videos talking about monthly paying dividend stocks. 7 highest paying monthly dividend stocks, 130,000 views, 12 best, 3 monthly dividend stocks, all 48 monthly dividend stocks. There was one that said monthly dividend stocks that'll pay your rent. What none of these videos, what I haven't seen any of these videos talk about are 3 significant disadvantages to owning monthly paying dividend stocks. And I want to talk about those in this video. So here's a list. This is from Simply Safe Dividends. They've actually done a good job here collecting a list of 4 companies with relatively safe monthly dividends. 3 important things to know about monthly paying dividend stocks is that oftentimes their dividends are actually extremely unreliable and extremely unsafe, and that leads to the stock itself performing poorly. Second thing is that the dividends from them tend to be very tax inefficient. Why is that? Well, they tend to be non-qualified dividends, and without going too much in depth, again, talk to your tax professional or financial advisor, but they are taxed as ordinary income. So if you look at your taxable income, you can see if you're in a certain tax bracket, you might pay 25% income, or maybe even 30%, or whatever that is. That is what you will pay on that income from non-qualified dividends. Qualified dividends, these are, say, Home Depot or Costco or something like that. Those are taxed at the long-term capital gains tax rate, which can be a little bit different for people, but tends to be as much as 50% less taxes that you pay on the dividends if they're qualified dividends versus unqualified dividends. So that's the second thing. The third thing is that monthly paying dividend stocks tend to significantly underperform not only the S&P 500, but dividend growth stocks, which is what I think most investors that are in their earning years, so anywhere between 20 to 50 or even 60 years old, if you're going to own dividend paying stocks, I would much prefer to own dividend growth stocks. I'm going to show you exactly why. So what I did was look at these fantastic dividend yields, 11.43%. These are monthly dividend stocks, 9%, 8%, and 7%. I took these 4 stocks and I looked at their historical performance. This includes stock price performance and dividends. And if we look, SLR, that was the first one, that one that pays an 11% dividend yield. Since 2010, SLRC is up 4.36% per year, including dividends, versus the S&P 500 up 12%. So sure, over that time, you would have received $14,500 in dividends. From stock price appreciation, you've only gotten another $2,000. If you would have invested in the S&P 500 over that same period of time, yes, you've only gotten $4,800 in dividends, but you've gotten total growth of $39,000. So even if you needed the income, you could have sold down your shares of the S&P 500, taken out more money than you got paid in dividends from this stock, and still been better off owning just the S&P 500. It would have also been more tax efficient if you plan that right from a tax perspective. But ideally, if we're in our earnings years and we're not needing this money, we don't want to be collecting that monthly dividend and paying taxes. We want as the least amount in dividends possible, because you have to pay taxes on those if they're not in a retirement account. And we want more capital appreciation or total appreciation, share price appreciation. So again, next one, SL Green, 9% dividend yield. SL Green, 3% compound growth since 2004 versus 9% from S&P 500. Again, $16,000 in dividends versus $7,800 from the SPY. But you only get $1,900 of additional growth on top of that versus $43,000 of additional growth from the S&P 500, just crushing that monthly dividend paying stock. Fourth one, EPR Properties, amazing, 8% monthly dividend yield. EPR Properties, here we go. Back to 2003. This one is the closest one yet, up 9.2% compounded annually versus the S&P 500 up 9.6%. So still, even in this scenario, better off just owning the S&P 500. Main Street Capital. All right, this is the one that is actually significantly outperforming the S&P 500 since 2008, up 16% compounding annual growth rate per year versus 9% for the SPY. So that one handily beats the S&P 500, would have been great to own, right? And if you notice, out of the 4 of these, this one actually has the safest dividend. So that goes back to that dividend safety rating. Now, what would I rather own instead of these monthly paying dividend stocks? Well, again, Simply Safe Dividend, which this is not an advertisement. I'm a paying customer of theirs. I get nothing for mentioning them in this video. They have a list of high dividend growth stocks, and doing nothing else, the way I've sorted this is just by the highest 5-year dividend growth. Why is that an indication of a good company? Because if a company can grow its dividend, that means its sales have been good, its earnings have been good, its income has been good, and they've gotten more and more and more income and earnings that they're able to continue increasing the dividend that they pay. And so the first 4 companies, I'm just going off the first 4 companies here: Cintas, Texas Instruments, Poolcorp, and American Tower. Again, the highest 5-year dividend growth that they've got: 23%, 21, 20, and 19. So jumping to Cintas, since 2002, up 12.5% versus the S&P 500, up 8.6%. So again, you want to talk about like needing some income, right? If you needed the income, you could sell down shares and still be way better off. None of those other comparisons had anywhere near $100,000. So $113,000 versus $54,000 total from the S&P 500. And I'll just go through the next 2, Texas Instruments and Poolcorp. Texas Instruments, 10.73% compound annual growth rate since 2002 versus 8% for the S&P 500, 84,000 versus 49,000, crushing the S&P 500, giving you plenty of income if you needed it. Poolcorp, which is down a lot, it's down huge, 18.6% per year on average compound annual growth rate from 2002 to 2022. $10,000 it turned into $363,000 because this is just showing the growth. So $363,000. All the income you could ever need that you could pull off of that if you needed to. Again, and that's not the goal, right? While we're still in our earnings years. And then actually, for the last one, I didn't do American Tower. I did MasterCard. I wanted to do MasterCard because it pays this tiny little teensy weensy dividend, but they grow it very fast, right? And so if we take a look at MasterCard, this one is far better. 30% compound annual growth rate, turning $10,000 in 2006 into $826,000 today. That, my friends, is why we can't just look at the cool fancy headline and what everybody's talking about, how cool and great monthly income is and monthly dividends, okay? Dive deeper, do research. I'm not saying never to own monthly paying dividend stocks. There are some good ones out there, and I'll do a video on some of them. But look deeper. Think about what actually works for great businesses. We want great businesses that grow sales, that grow earnings, that grow income over time, and if they pay a dividend, they grow it over time. We want to buy them at just reasonable enough prices, right? If you appreciate these straight to the point videos, you can help support me for free by just liking this video and subscribing to the channel. That really helps other people find the video. Let me know in the comments if there's a monthly paying dividend stock or a dividend growth stock that you want me to review, and I will review it right here on this channel. Have a great day.